and welcome to an absolutely fresh and new version of Trading Hour. I'm Ekta Batra and with me is Prashant Nair. Well, through the next 1 hour, Trading Hour will take you through the top stocks that are making news and buzzing at 11 a.m. this morning. Not only this morning, every morning. And not just that, stay tuned for our brand new feature, 11 at 11. A total of 11 strategies in 60 minutes with trading calls every 15 minutes from both the equity and the commodity space. All this and more over the next 1 hour. Hi, Prashant.
Ekta, hi. New look trading hour with old
the
faces.
Anchors are the same.
Okay, all right. So we'll get you the first three of those trades straight away in just a bit. And I want to just take, under 60 seconds to take a look at what is happening globally. I mean, the correction that we're seeing. And, if you've been watching the show, you cannot say that we did not warn you that maybe this was coming. I mean, actually on Thursday and Friday, we put out short pieces which explain that why, the market maybe, and if you can have graphics up, it'll explain the point clearly, why the market is actually, global markets and S&P to begin with, were at important points where they might actually be a bit of a sell down. So, and we also said this, that while the market may, because, the pullback, okay, let me just begin right at the start. What happened? Around Christmas of last year, that is, the last week of December, the S&P 500 was at its 200-week moving average. And from there, for 2 weeks, the next 2 weeks, 2.5 weeks, it saw a straight line up move. That was about 10%. And it got us exactly to the 2600 kind of resistance levels. And that is the reason why, late last week, we said maybe things start to turn around a little bit from those resistance levels. And that is actually exactly what has happened, almost to the T. Now, the fact is this another big leg down, or are we in the process of bottom formation? From the looks of this, it looks like this is, the market forming some medium-term stronger base. And the reason I say this is because in the past as well, the market, the index, the US market has formed double bottom formations around the 200-week moving average. So we got one touch point in the last week of 2018, and it is possible that the market, maybe overshoots, goes back to those levels and starts to turn around a little bit. So, I'm not saying that while the market corrects, it will not look scary. People will start to raise doubts, etc. But at this point, looking at the pattern and everything else, it looks like this is just a pullback after the market having gone up 10% in a straight line. And it is showing up everywhere else. You look at Asia, most Asian indices are down. Hang Seng opened with a big gap down. Another index we spoke about on Friday. So, everything else follows. US starts to drop. The rest of the region, equities around the globe start to follow as well. Otherwise, in terms of fresh news flow, global themes, pretty much everything else remains exactly the same. Ekta.
Well, yes, absolutely, Prashant. And we can't take away from the fact that we have a lot of stocks to reckon with today. So we have the likes of Infosys, which is obviously topping the charts in terms of news. But separately, even something like a Federal Bank, which is down and out today. So that stock is down around 5% Avenue Supermarts, which is reacting to what was a disappointing set of numbers, at least below the revenue line. And other stocks include something like a Sun Pharma as well as Spark, which are managing to hold their head above the water in a weak market. But let's get you those first set of strategies on Trading Hour. Sudarshan Sukhani joins in to take us through that. Sudarshan, hi, morning, over to you then. What would you be recommending in terms of the equity calls?
Yeah, good morning again. Well, the Nifty is now in a trading range and almost at the lows of that range. So 10,700 is our support level. If support breaks on a closing basis, I think long positions will have to be closed. We'll see what happens today. And this could easily be a bounce off stage also, but it doesn't look like that so far. So avoid the indices, watch the 10,700 level for a trade tomorrow. Individual stocks keep on offering opportunities. The stocks that are giving us buy opportunities are the same sectors: pharma, IT, FMCG, consumer goods. So Divis Lab is a buying opportunity. The stock has done well and is now rallying even in a weak market as of today. Bata India is another buy. New highs in that stock, small corrections, a renewal of that uptrend. So these are outperforming stocks where we should be buying on dips. Bata India and Divis Labs are buying opportunities, and all metals are short sells. So among the metals, I am choosing Tata Steel today for a short sell intraday. but avoid metals completely.
Okay, Bata India, Divis Labs and Tata Steel are the strategies coming in from Sudarshan at this point. We have a Twitter query for you, Sudarshan. Nikunj holds 100 shares of Aurobindo Pharma at 605. He wants to know if he should hold or sell that stock. Are you as bullish on pharma as you were a couple of weeks ago?
Yes, you should hold on to it. Auro Pharma is, I think you're talking about Auro Pharma, isn't it?
Yes.
Yes, hold on. Hold on to any good quality pharma stock. That would be a generalized opinion. But for Auro Pharma, it's been an outperformer. A small correction is behind it. Whatever happens to the Nifty, pharma stocks should outperform in the next 3 to 4 months. Stay there.
Okay, Sudarshan, thank you very much. And we'll speak with you soon again. Appreciate it. Well, on to the top buzzers at this hour. Infosys is standing out. It's actually the top Nifty gainer after the company increased its growth guidance for FY19 even after margins missed expectations in the third quarter. Rima is here to take us through the big highlights. 2.5 on Infosys. Rima, morning.
Well, Infosys is gaining because it's catching up with respect to TCS in terms of its growth rates. And remember, it was always trading at a valuation discount of more than about 20%. And that seems to be narrowing as the growth rates converge for the top two IT makers. This, in fact, is the second consecutive quarter of Infi's growth being higher than that of TCS. So this quarter, Infi had a 2.7% sequential improvement in its constant currency versus 1.8% for TCS. As a result of this material beat on the revenue, the company has upped its full year revenue guidance. So now in the third quarter, on a constant currency basis, Infi actually hit the double-digit mark. It had a 10.1% growth on a year-on-year basis. So because of that, it's up the full year growth estimates to 8.5% to 9%. And no one on the street was expecting such an optimistic guidance. The previous guidance was at 6 to 8%. But there was a sharp margin contraction, as you pointed out. Margins declined by 110 basis points, which is why the company continues to retain its old guidance of 22 to 24%. On expected lines, the company has also announced a bonanza for shareholders, special dividend of 4 rupees per share. There is going to be an open market buyback at a maximum price of 800 rupees. So that's a significant more than 15% premium to where the stock is currently quoting. The internals of the numbers look quite good. So BFSI growth, a digital growth of 33% year on year, deal win strong and more than $1.5 billion. Credit Suisse says that as the growth rates catch up, its valuation discount to TCS may reduce. Kotak has upped the revenue estimates, but they've cut the EPS estimates on the back of the margin miss, while CLSA ups the target price to 930.
Okay, thanks Rima for that. So definitely a bit of a margin disappointment coming in for Infosys, and that seems to probably be the one commonality that we've seen with Avenue Supermarts, which came out with its numbers over the weekend. It was a margin disappointment for that retail major. In fact, for the second consecutive quarter. Mangalam is here to break down the numbers for us. Mangalam, stock down 8%.
Well, the street is worried that, the company is chasing its revenues at the cost of margins, and which is why we're seeing that correction on DMart in today's trading session. Revenue growth of 33%, absolutely in line with what the street was working with. However, the EBITDA margins came off by about 200 basis points, and this is primarily on account of gross margins coming off and the management saying that they've preloaded certain expenses, and at the same time they had higher operating costs on account of the festive season, where a lot of their stores actually were working overtime, and those after hours store openings continue well into this quarter as well. On the back of that, the net profit was absolutely flat, growing at just about 2%, and that is something that the street did not like, especially given the fact that the stock is trading at 75 times FY20 earnings, on the back of which the brokerages are a little cautious as far as DMart is concerned. So Edelweiss, for instance, they believe that in pursuit of the revenue, companies' triggers to expand margins going forward are a bit disappointing. Add to that the pace at which the company is growing its stores. Just 4 stores added in this quarter is not up to their expectations as well, which is why they retained their sell on the stock with about a 1,300 rupee target price. At the same time, we have Motilal Oswal as well saying that the revenue growth looks promising, but margin triggers are lacking. They have their sell rating on the stock with about a 1,400 rupee target price as well. So brokerage is not too enthused, primarily on account of valuations. For other companies, a 33% revenue growth, 8% growth in the EBITDA and 2% net profit growth would perhaps be okay-ish. The street would have given it a longer rope. The DMart stock did get a longer rope in the previous quarter, but now 2 consecutive quarters of EBITDA margin miss and net profit miss is something that the street is not liking.
Okay, Mangalam, thanks very much. Avenue Supermarts, lots of commentary coming in on there and lots of discussion. J&K Bank is the other one. It's trading higher despite the bank reporting a mixed bag for the third quarter. Abhishek is here with more. Abhishek.
Well, Prashant, to begin with, the net interest margin has improved to 3.76 versus 3.69 in the previous quarter, and the profit growth is healthy at 43% YOY and nearly about 11% on a sequential basis. However, the loan growth has come down to 12% YOY. That was at 24% YOY in Q2. Even if you look at the sequential loan growth, that has come down. It was at 6% in Q2 and it has come down to around 2% in Q3. The asset quality saw a slight hiccup on account of the IL&FS recognition that the bank has done. So gross NPA in absolute value increased by 13%, while as a percentage it increased to 9.94 versus 9% in the previous quarter. Lower tax rate, the tax rate was at 40% versus 45% that we have been seeing over the past few quarters. However, brokerages believe that the valuations are very attractive and Kotak Securities has a buy call with a target price of rupees 90 per share.
Okay, all right, Abhishek. Thanks very much for that. So that's J&K Bank. We need to take a break now, but up next we'll discuss the crude price outlook with Manisha Gupta. Miswin Mahesh, crude expert, will be with us and we'll get you the rest of those commodity strategies as well.